Hi guys, welcome to Phoebe Explains. Today we're going to talk about relative valuation using two methods, direct comparison and regression analysis. Let's get started. For the first method, direct comparison, it is a relatively straightforward method. The first step is to select peer companies, and there are different metrics we can check for selecting the peer company. We can look for size, industry, location, and financial performance. For example, if I want to find peer companies of Apple, we may select the ones that are located in US, that are mega cap, and at the same time in tech industry. Then I'll see the profit margin, growth rate, etc. to see if there are some good approximates of Apple. One tip I can provide is that sometimes we may review the financial statements or annual reports offered by the company to see if these reports contain competition section. Sometimes the company may tell you their competitors or like their peers directly. We can use the peer companies provided by the company as a benchmark. The second step is to choose multiples. There are two types of multiples. The first one is equity multiples like PE, PB, PS, etc. And the second one is enterprise value multiples like EV to revenue, EV to EBITDA, etc. I guess one main difference is that for equity multiples, it's good for the companies with similar debt level so that the capital structure will not alter the result a lot. And for the enterprise value multiples, that is EV multiples, it's good for peer companies with diverse debt structure. We can also consider the sector where the company lies in. For example, if it's retail sector, then price to sales ratio may be more important. And at the same time, if it's bank, then PB value should be more suitable. Now let's move to the third step. The third step is to calculate the industry median or average. For example, if we selected the P ratio of 7 different companies in the peer group, and we found that their P ratios are 6, 12, 13, 14, 15, and 16. Then we can find the corresponding average and median for these P ratios. Normally, we may prefer to choose median as median value is less affected by the outliers. Now let's move to the last step, compare target company. Our company's P ratio is 12, so compared with the median, it's less than 14. So we can find the upside potential, that is the predicted value divided by the actual value minus 1. So here, the predicted value is actually 14, as this is the median of the peer group. And the actual value here is 12. So we can see there's upside potential of 16.7%. We can also use this formula for finding the downside potential. Now let's have a look at this Excel example. Here we can see the company we want to value is Apple, and we pick several companies as the peer companies for Apple. And then we find their corresponding PS ratio as follows. Now we need to find the predicted multiples, that is the median of the group. We can directly use this formula. And now we can find the upside or downside potential of Apple, which is equal to the predicted multiple divided by the actual multiple minus 1. We can see it's equal to 0 here. Well, this direct comparison is simple and quick. At the same time, it's easy to understand. However, it's sensitive to outliers, and at the same time, it ignores the differences in the financial drivers in different companies. Now let's have a look at our second method, regression analysis. For this method, we take more factors into consideration. So the first step is, as the previous one, select the peer group. And then for the second step, Here, we not only consider the valuation multiples like EV to EBITDA or like PE, etc. We also consider other financial ratios like revenue growth rate, profit margin, net margin, risk factors, etc. We set these financial ratios as our independent variables, and we set the valuation multiples as our dependent variable. Let me use an example to better explain this. Let's take profit margin as the independent variable and P/E ratio as the dependent variable. And we find the corresponding combination of profit margin and P/E for different companies like Apple. For example, Apple lies here, and its peers like Cisco lies here. Nvidia, although they are not really same, lies here. Microsoft, just assume Microsoft lies here. Now if we move to next step, that is run regression, we aim to find a regression line indicating the relationship between the dependent variable and the independent variable. So for example, in this case, as the independent variable is profit margin, dependent variable is PE, here we aim to find a regression line, probably some line like this, where the distance square is minimized. We don't need to do it manually by ourselves, as we can use Excel to find this directly. This regression line link valuation multiples to financial drivers. Taking Apple as an example, here this value is the actual value PE of Apple. After finding the regression line, we can see that for this profit margin, the corresponding PE, the PE predicted, is here. We can thus find the upside potential or downside potential of Apple. Now let's have a look at an example using Excel. Here, the multiple we use is PS, price to sales, as before. So these are the actual multiples we found online, for example, from Yahoo Finance, Bloomberg, etc. Here we set our independent variables as operating income growth rate and net margin. And now we want to run a regression in Excel. How can we do that? Well, we can click the data here and then go to data analysis. The first one is regression. We click OK, and then we may need to select our Y range and X range. So for Y range, it's our dependent variable, so it's here. And for X range, it's our independent variable, so it's here and here. It's better to put all the independent variable columns together, so it's easier for you to select them at once. You can click the label here if your first row is the label, but here the first row is not the label, so I'll not click the labels here. And then we can select its output range, probably here. And then we can click OK. Now we get the summary output. So this is the regression statistics offered by Excel. And as we can see, for this regression formula, A is just the coefficient for operating income growth rate. So this is our first variable. So X variable 1 coefficient. So the value of A is just this. And here, the value of B is the coefficient for the second variable, that is this one. And the value of C is just the intercept coefficient, this. Now we can get a formula of the regression line from these coefficients. That is, price to sales ratio is equal to this value multiplied by operating income growth rate plus this coefficient multiplied by net margin plus the last one. Now let's copy the formula here and paste it here. we can remove the previous PS here. It's equal to Z's formula. And we can replace this name to the exact value here. And we can replace net margin by this exact value here. Now we can get the predicted multiple of PS. And then we can drop this down. As we can see for Apple, the predicted multiple is smaller than the actual multiple, indicating Apple is a little bit overvalued. One thing I want to mention a little bit is regarding the R-square here. This value is also really important. The closer the R-square to 1, the fitter the regression line is. So we aim to find a relatively close value to 1. 0.63 indicates a moderately fit regression line. In today's video, we've learned direct comparison and regression analysis for conducting relative valuation. Hope you enjoyed today's video. See you in the next one. Bye!